Well, hello there, my friends. Chris Marcus here with you for Arcadia Economics as we are back on the air covering rather fascinating situation as the pressure in the silver market continues to build. We have new people joining by the day. I personally think this story speaks for itself, does not need any sensationalizing. And that's all we're trying to do here is provide accurate information so people can at least understand what the risks are. I am not a legal financial advisor, but an analyst. And that's why I'm happy to have Nick Barisheff of the BMO Group, expert who has done a lot of research into the ETFs. And also I'm going to pull up Nick's site here. And Nick, great to have you back on here today. How are you?
I'm great. Pleasure to be back.
Well, I appreciate that. And Nick, again, there's a lot of new people to silver. Here is your site, but perhaps just before we dig into SLV and what your research has found, can you let people know about your background just so that they can be clear on your credentials and experience, and that I think you are an expert certified witness on this topic?
Well, basically, I guess I've been in this particular business since 1998. I thought there was a market opportunity because in Canada, there wasn't a good way to hold precious metals in a registered account like RSPs in Canada, similar to your IRAs. The only thing available at the time was the central fund. And a central fund is a closed-end fund. And the big problem with it is that the liquidity is much smaller than what the liquidity is in the bullion markets. And also it didn't act like silver, or sort of like gold or silver at critical times. So but what you want to hold is the bullion because it's negatively correlated to financial markets. So if financial markets decline, it tends to go up. But what was happening with the central fund is when the markets went down, it went down by even greater amount. So it totally defeats the portfolio aspects of holding physical bullion. Same thing tends to happen with mining stocks because the market cap of all the mining stocks in the world is a fraction of Microsoft alone. So if you have a major sell-off in equities, the mining stocks will tend to drop by much larger percentages than conventional equities. So what I wanted to do was to set up a qualifying fund for registered accounts, but at the same time that it would exactly act like bullion. So the key to that was I chose an open-end mutual fund structure, and that had never been done before. So mainly it accomplishes the first objective. It has the same liquidity as the bullion markets themselves because you buy bullion in the bullion markets and you redeem it into the bullion markets. So there's no liquidity issue on how many shares trade in any single day.
Right.
And even with the big ETFs, their trading volumes are nowhere close to the actual bullion markets. So they're not quite there either. The second thing is that I wanted it so that there was no human interference. So when you hold bullion in a portfolio, you don't want to be dependent on a portfolio manager to make the buy-sell decisions because he could be wrong. And many times the bullion markets don't act the way they're expected to or supposed to. So the issue, you want to leave them alone. You buy them, hold them, you decide when to sell them, and other than that, we leave them alone. So that's the important difference between an ETF and an open-end fund. So when money comes into our funds, we get a report every day from the administrator, and then we buy the appropriate amount of bullion that day. But in all the ETFs, the manager, you've got custodians, managers, trustee, etc. They don't actually handle any of the purchasing of the bullion. Authorized participants do. So an authorized participant, and they carefully, select the wording. They say an authorized participant assembles a basket. Now, a basket is defined according to the ETF. But in the case of an SLV, it's 1,000-ounce silver bar. So they assemble baskets that they then contribute to the ETF. The ETF issues them shares, and then they sell the shares to the public. Now, they also act as market makers. So when investors want to sell shares, they redeem shares and in exchange for bullion, and they try and keep the premium to discount in a narrow range, but they don't have to. And just as market conditions are normal, it benefits them to do the arbitrage spread between the market price and the net asset value. So that's the critical difference. But the question nobody asks is, so where do the authorized participants get the bullion? Do you really think they go out and buy it, contribute it to the ETF at net asset value, to get shares at net asset value, to sell to the public at net asset value? Where's the money in that? There isn't. So what they're allowed to do, whether it's an equity ETF or otherwise, you can borrow the shares or the bullion or whatever the case may be. And then you can contribute the borrowed bullion. So the first part of it is when auditors go and look at the bullion and say, whoa, we counted the bullion and all those bars are there. Well, if I was a banker and you gave me a financial statement that said you own a Mercedes-Benz, and I went over to your house and I looked in your garage and there was the Mercedes-Benz, it doesn't mean you own it.
Right.
Okay. I would have to ask you, well, let's see the title documents and everything else. And so, well, it's leased actually, And that's the missing link on all the ETFs. The big problem with that is in any leasing transaction, whether it's a car or gold, the lessor retains title to the asset. So in the case of the car, you get to drive the car temporarily, but it's the lessor's car from a legal ownership point of view. And title never changes. So the critical thing which nearly happened in the case of the Lehman Brothers insolvency, because they were authorized participants, is if the authorized participant becomes insolvent, the lessor can simply go to the ETF and say, send back my bullion. And that would be that. The people that bought the ETF would lose that portion of the bullion that the lessor placed with them. So the issue comes is that in the case of equities, the brokers can borrow equities from their clients' margin accounts. They don't have to ask you for permission. You don't even know they've done it. So what you've got is equity ETFs with investors thinking they own those shares. And you've got the original shareholders that they were borrowed from think they own the shares. So the problem exists from inception. Sooner or later, somebody loses. You can't have both people own the same asset. Now, in the case of gold, it's a little bit easier because they can borrow gold from central banks. Central banks hold a lot of gold. Silver, not so much. Now, there's supposed to be a lot of above ground stocks, but I think those above ground stocks are highly dispersed. So it's not somewhere that an authorized participant can go and borrow tons of silver. So that's the first big question. Where does the silver come from?
Yeah, Nick, a lot of great points you raised there, and I appreciate you laying out the foundation, because what you touched on the last one, that's the mystery question that nobody seems to know. Because I'll pull up, here is an article. We'll come back to that one, but here's the iShares site. I did call them on Friday and confirm that if they say they add 10 million shares on Friday, the metal is placed in there on Friday, according to the iShares representative. I said, who's responsible for doing that? They say JP Morgan. Again, I think it's reasonable to point out, here's a couple months ago, JP Morgan, manipulative, deceptive conduct, not a few times, hundreds of thousands of times in the precious metals market.
Mm-hmm.
Now, in the past 2 weeks, the Friday, Monday, and Tuesday of last week, from SLV's own data, here we have, so here's 28th, which was the Thursday. That was the first day that silver squeeze became a known thing. Then by the end of Tuesday, you've had 120 million ounces added in 3 days. I brought on one bullion dealer, or one after another, analyst after another. I don't know anyone who's involved in the silver market that thinks that's possible. And then in addition, what you just mentioned, here's Ronan Manley's article. I hadn't realized this, but you have the other silver trust, Invesco. Custodian is JP Morgan. PMAG, PMPM, custodian's JP Morgan. SIVR, custodian is JP Morgan. Not to mention, JP Morgan has on their COMEX report 193 million ounces in their account. And I was stunned when I was asking SLV for the audit. First, you couldn't find it. And then I'll show you what they gave me, but the date was stamped March 20th of last year, the Friday before the EFP market broke. So ever since then, nobody's looked at it. Nobody's even saying there's oversight. We have these large pools of metal. You explain the risks, and we have an amount of metal allegedly added that no one believes is possible. So, Nick, any thoughts on any of that?
Well, the first thing is the custodian has typically nothing to do with purchasing and redemptions. So, for example, in our case, we have a custodian and we're the manager. So it's the manager that decides what to buy and what to sell. The custodian simply keeps track of the bullion, and it's kept in safekeeping on an allocated insured basis and so on. But they're not involved.
Nick?
Sorry?
If I could just hop in there, I would agree with what you're saying makes sense. I'm just repeating directly. That's what she said. So continue.
So the issue is that typically when we make sure we're careful of, it's not just the fact that we can have the auditor go into the vault and let him count the bars. He has to check the sale transactions so that every time we buy a bar, it says, okay, we're buying this bar, serial number, refiner, exact weight and purity, and so on. So you've got the purchase and sale transaction that then has to match what's in the vault. Okay, if you don't have the purchase and sale transaction, you don't know that stuff actually belongs to you. So that's the missing piece. Now, when you read particularly the GLD authorized participant agreement. And this is where it's critical. Normally, when you take any hard asset and I'm selling you the hard asset, whether it's a house, a car, a boat, an airplane, I will say, as the vendor, I have legal title to this hard asset. There's no encumbrances, and I have the right and legal ability to convey it to you. That's the way normally it works. In a GLD, when you look at contributing bullion to the GLD, it says, when I, as the authorized participant, contribute the bullion to the GLD, after closing, you will have clear title. So that would be like buying a house, and the vendor says, don't worry, search and title or whatever. After the deal closes and you paid me, you'll have clear title. It's not the way it works. So it's a specifically missing piece, because when you go a little bit further down and where the authorized participant is redeeming bullion, then the GLD has the regular reps and warranties when the bullion is going back to the authorized participant. It's only a couple of pages apart. So because I've sat through many prospectus drafting exercises with many lawyers and so on, this is not an oversight, okay? This is purposely done that way. $1,000 an hour New York lawyers don't make those kind of mistakes. So this is done unless you're used to reviewing those kind of agreements, that would slip by. The other thing would slip by, which is right on the first page, if you look up the GLD, the ETF, it says, this is meant to track the price of bullion. Now, if you and I, we can create a tracking vehicle without owning any bullion, just create a database, and people can bet on tomorrow's price all they wish. We don't need any bullion. Okay, and they carefully make sure they're not saying this is about owning bullion. Okay, this is a tracking vehicle, and it's a tracking vehicle that's outside of the jurisdiction of the SEC and the commodities futures market. There's no rules on what should be in the prospectus in the first place. They're outside of those rules. It says that on the front page too.
Yeah, I mean, I've been stunned by what I've found in there so far, and some of the discrepancies and things that, again, I don't know exactly what's going on yet, but I feel that I would be violation of some fiduciary responsibility by not at least bringing up what I'm seeing. Nick, another question, perhaps you can explain, because I haven't been able to find anyone who can figure this one out yet. You remember about a week ago, following the silver squeeze hashtag, there was a big rise Sunday night into the market. We saw silver cross over 30. Again, we've heard about, and we've discussed on my show, the First Majestic short squeeze. First Majestic's up around $25. Then we see this familiar pattern, a lot of volume there, right when the price gets slaughtered. Nick, you can comment in a minute. I know you've talked to other bullion dealers. There was a lot of buying. So this is February 1st. Here's February 2nd. You see the same pattern here. I might add, here is a report from JP Morgan released at 5 a.m. on February 2nd, saying that they expect silver to go down. We see a lot of volume on the market, and I might add some of this was, here, this is like 4 a.m. in the morning, or this is 6 a.m. in the morning. It was right around, here's around where JP Morgan's report comes out. So a lot of unusual trading activity, but here's what I don't get. Price declined 10% on that day, yet JP Morgan, or iShares, that has confirmed nobody has looked in this trust since last March, on the day of the second, when the price came down 10%, they claimed to add 61 million ounces. Might add in the same day they gave a sell recommendation, and that 61 million was in addition to 50 million the previous 2 days. Nick, how does the price decline by 10% when someone adds 5% of the annual supply into their trust alone, let alone what was going on with the bullion dealers?
Well, this is where you've got the disparity between, paper and physical. So first of all, there's a bunch of separate markets. So it was widely known that the various coin dealers and so on were out of stock, the mint was behind, and so on. So the coin market is one market. In terms of ETFs and funds and the COMEX and so on, those are 1,000-ounce either LBMA or COMEX bars. It's a totally different market. Now the problem is the price and volume is coming from the COMEX, which is all paper. It's not exchanging physical for anything. Okay, so the trouble is if you're a big bullion bank, you could sell naked short on the COMEX without limit, as much as you want. Okay, where ordinary investors can't do that. And the same applies in reverse. So what you've got is a totally artificial paper market, which has nothing to do with the physical. Now, at some point in time, the way that breaks is that when too many people have bought on the futures market and surprisingly ask for delivery, okay, and they can't deliver because the paper sales are about 100 to 1 compared to physical. So then the whole game blows up. So there's all kinds of discrepancies. And if you marry the manipulation on the COMEX and then what's happening in the ETF, is the combination of the two is where the problem lies.
Yeah, and Nick, you mentioned discrepancies. I want to be careful how I phrase things for both of us here. I'll just show you a couple things that seemed odd to me, and I'll say, are these things that you would at least want more clarity on before you would feel, it sounds like, comfortable investing? I'm getting the feeling you would not be comfortable investing with this thing anyway, but if you will indulge me. When I called iShares and asked for the audit, the only thing I was able to get was this inspection of silver bullion. I thought it was interesting. The date this is stamped is March 20th, which I'm sure you remember was in between the Sunday night quantitative easing announcement on March 15th. The Fed announced quantitative easing. Then by the 23rd, they had supersized that to unlimited quantitative easing, which blew out the EFP conduit between New York and London. So again, that was the first thing I thought about when I saw this date. And then I looked a little further. The audit took place between February 10th and March 6th. And was curious when that was. Here's March 6th, price is $17.21. And by March 18, it's below $12, which struck me as concerning that given everything else you've raised, the last time anybody besides JP Morgan, who again has settled without comment for hundreds of thousands of spoof orders in the CFTC's words, so the last time anybody looked at it was right before what I think most gold and silver industry participants would say was not legal trading. But I'm going to raise one more question, and then you can perhaps comment what I don't get, and you tell me if this seems strange to you. So here's March 16. There's 378 million ounces in the trust. And from March 16 to March 17, it goes up to 391. So about 13 million ounces are added. And according to the way iShares told me the thing, so they said if we add it on March 17, that's when the share goes in, or the silver goes in. Yet here's March 17th. You see what happens on March 16th. when the price of silver goes from about $14.75 to below $12. Then the red line, here's March 17th, when customers are purchasing 13 million shares, which iShares claims is going in, and the price is hanging out, and then the day after that goes down even farther. Is there any way that makes sense to you outside
the main
of?
thing, you've done a lot of work there, but the main thing you've got to look at is what is happening on the COMEX on those days, and what is happening to the SLV on those days. Like they're two separate things, and that's where both the conflicts and so on happen. For example, as a fund manager, I can't front run when I know that we've got purchases coming in. So before I go out and buy the bullion, I can't front run it and do that. That's the same thing across the board.
Right.
So the issue is you're not front running it in the SLV, you're front running it in the COMEX, and you can make it go either way. Now the authorized participants, when they've borrowed the bullion to contribute, they're effectively short. So what they want to do is create a process where SLV investors are redeeming, and they're buying back cheap so that they can pay off their loans cheap. Okay, and that's where the conflict lies. And the issue is if you have a decline in price, whether it's orchestrated or not, then it's in the authorized participants' best interest to wait and let it decline. So when you have precipitous declines, you'll find that various ETFs, whether it's an equity ETF or a bullion ETF, will decline by more than the investments that they're supposed to represent.
Yeah.
Because the authorized participants have stepped aside.
Okay. And I guess another question that we've been getting a lot here is people are looking at PSLV now. I've been trying to get someone from PSLV on the show, but what would you say in terms of PSLV from what you've seen? And is that something you feel comfortable with?
I haven't looked at it in the same depth that I did for the GLD and SLV and so on. So there's a lot of smaller ETFs that have slightly modified, operating procedures and so on. But I think the whole ETF concept is a flawed concept right across the board, no matter what you're buying. And sooner or later, all it's going to take is for one ETF somewhere for an authorized participant to become insolvent. And then you have a dispute between the lessor and the lessee, and the ETF investors will end up being the losers.
And based on the things that you've been discussing today, again, just to be clear, do you feel that there is heightened risk, especially with how much money has been flying into some of these trusts, that there's a heightened risk of that issue appearing?
That's right. Because like I say, a lot of people are attracted to ETFs as compared to open-end mutual funds because they think that this is an opportunity because it's low management fees for ETFs compared to mutual funds.
Well, I appreciate you mentioning that. Last question I have for you today, Nick. I believe there is one of the larger delivery periods for silver coming up on the COMEX in March. So that will begin, let's say a little bit over 2 weeks from now. Is it possible that given there's a lot of metal going in, JP Morgan still has that account in the COMEX that has a large amount? Do you think we may see something happen on the COMEX? I mean, there's ever been a time where there could be a scramble for metal. We heard from the bullion dealers. We heard of a warning from the mint. Are you expecting anything there in a couple of weeks?
Well, again, the scramble for the metal for the bullion dealers is coins. It's not, 1,000 ounce or 400 ounce bars. That's a totally different market.
Right.
And that's the market that both the ETFs and the COMEX use. And same thing we do. We only buy 1,000 ounce silver bars. So there's a disparity there. Now the question becomes is, can you have a situation where, at the appropriate period on notice day, a number of COMEX investors stand for delivery, and there's a big surprise, and then they can't deliver, and the other side of the equation then has to go to the market and buy the bullion to deliver. Then you have a huge spike.
Right.
Now the thing is that in the past, the COMEX can change the rules to avoid that and force a settlement in cash, so they can get out of that.
And do you think that we are getting closer to seeing something like that?
Well, it's possible. I think that like the Reddit example would be much harder to pull off in physical silver in the COMEX, and most of those Reddit investors won't have futures contracts. It's a totally different game. So it'd be much harder to pull off, to have a sort of a retail surge to ask for delivery.
Okay. Although on the other hand, we do have Janet Yellen, Jamie Dimon, and Joe Biden meeting today talking about going big. So we'll see how that plays out. I guess I just formed two follow-up ones here. We'll make them quick. But you mentioned the 1,000-ounce bar market. Have you seen any signs of anything unusual there yet? Or so far in the wholesale level, things are still normal?
Not in the thousands. In the coins, it's becoming tighter. And platinum is all, like in platinum, we buy 50-ounce bars. And at times, there's been a delay in delivery because a lot of the platinum comes either from South Africa or Russia. So sometimes we've had several weeks delay, but there has yet to be any kind of issues on 400-ounce gold or 1,000-ounce silver.
Okay, well, I appreciate that update. And just the last one, I don't know if you happen to know this type of thing or not, but again, this letter says here the record date was February 7th. Today is February 9th, a year later. Any idea, would they be required? And I've heard somebody say there was another inspection in August. I'm just going by what SLV sent me, but do you have any idea, would that be safe to imply that they should be starting another count and audit right around now, or you just don't know on that?
Well, again, you've got to go back to the fact that, and on the first page of either the GLD or the SLV, it talks about it not being subject to either the SEC or the Commodities Exchange. So there are no rules that apply to them. Like in the case of our funds, the requirement to audit, how often, what it's supposed to consist of, all that's laid out in detail. That doesn't apply to ETFs.
Right.
Okay. So the issue, there's a lot of investor protection features that don't apply.
Yep.
Okay. So if you have a complaint by the shareholders against the trustee, the custodian, there's almost nothing you can do about it.
Yeah.
It's not the case in the others. So it's a problem all the way around. It's my view that shouldn't have been allowed to take place. Eventually, it's going to be a giant blow-up because we've got an enormous amount of assets that have been double counted. Whether it's equities, bonds, bullion, you name it, it's essentially being double counted.
Well, Nick, I appreciate you shedding some light on that. There are a lot of signs that don't seem to indicate everything is above board. So perhaps in wrapping up, if you have any final thoughts and can let folks know where they can find you.
Like I said, we're unfortunately, we only sell retail in Canada. We sell around the world, but then only to accredited investors and institutions. And we also have a bullion bars program where we sell physical bullion directly to investors, and we have arrangements with Brinks, different parts of the world for allocated custody. So we have many high net worth and family offices in that program. So they're two distinct areas.
Well, Nick, I appreciate that. Folks, you can find Nick and the BMG Group at bmg-group.com, also in the description field below. Nick, certainly an exciting, adventurous time in the markets, but I appreciate you joining me, making some time here, and at least giving your opinion. As everybody needs to do their own due diligence on these things, but I thank you for joining me and sharing from your experience what you've been seeing.
Great, my pleasure. Thank you.